you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite
Welcome
low.
back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to talk about the American liquidity crisis and not just the quantitative tightening that's going on right now. Before I get into what's going on right now with the liquidity draining out of the market at like record speeds, I want to remind everyone why we're in this situation to begin with. Essentially, the reason being excess liquidity through the virus shutdowns. Remember, you guys, not just the stimulus that was printed and sent directly to consumers. We also had liquidity injections in the form of EIDL and PPP fraud loans. And those PPP loans, almost all of those loans were 100% forgivable. So many small businesses and businesses got free money, and not just a little bit, you guys. They got a tremendous amount of free money. So now the question is where's that money at, and what happens when the liquidity is completely drained from the market? And so today what we're going to do is we're going to follow the money, because the reality is we need to follow the money, because the money has been propping up the economy this whole time, which really caught me by surprise, especially when it comes to the existing home prices. Now, we've had massive prices and deflation with homes, but in the new home sector. Now, the situation with new homes, guys, it's metro area specific. In some metro areas, they have massive clusters of new homes, and in some areas they don't. But again, you guys, what I want to figure out is when the propping up is going to start, or rather when the Federal Reserve is going to start doing money printing again. Now, if you guys can, for putting this together, if you want me to cover more subjects than just the housing market, do me a favor, shoot bonkers below, hit like, hit notifications, share this video, and either way, I hope you guys enjoy. Now, when it comes to liquidity in the market, what we want to really be paying attention to is what's called the reverse repo market. Basically, you guys, there was so much money printing, the Federal Reserve, the government needed to do something about it because there was too much money. And behold, the reverse repo market. Now, this is a one-day market. Basically, banks can store their money in here and they yield back 5.3%. And that's an annualized rate, obviously. So in one day, 365ths of the annualized rate, okay? But regardless, you guys, this is something we need to be paying attention to, because this is the main culprit at propping up the markets, at least in my opinion. So when this goes away, it stands to reason that's when the cracks in the economy, in the housing market, start to fall apart and break, because we see the cracks right now. But at the smoke screen, you guys, I want you to look at the reverse repo market as a smoke screen. This is the smoke screen right here. I mean, right now, and I want to tell you guys, basically, essentially right here, guys, is where we peaked in the reverse repo market. So we peaked in the reverse repo market back in December 30th of 2022. So a little less, let's just say a year ago. So a year ago, we had $2.55 trillion in the storage account for excess money, the smoke screen. So again, about a year ago, we had 2.55 trillion. If you guys fast forward to today and you guys see it really started shrinking after May 31st of this year, it has been plummeting and is now sitting at $793 billion. That is a drainage, you guys, a liquidity, and this is crazy. This is crazy fast. The money is being drained from this account faster than the government is basically spending money. The change in just 1 year, you guys, is $1.75 trillion. So yeah, this is propping things up, but it is quickly, you guys, quickly unraveling and dissolving. Now, that's a lot of money in 1 year, but if we really go back to about May 31st right here, you can see that's when it really started going down and deteriorating. Back in May 31st, we were sitting at $2.25 trillion. Okay, so $2.25 trillion. If we fast forward to today, that is a loss, you guys, in about what, 7 months of 1.46 trillion. Again, from May to right now, a loss and liquidity drain of $1.46 trillion. So I have a question if for any economists that happen to listen to this video, what happens when that money's gone? Obviously, they're spending that money like crazy, but what happens when it's completely gone, right? That's the question. And I've listened to a lot of videos on the reverse repo market. So what people are saying is when that's gone, the government, the Federal Reserve is going to lean on the Treasury. Now, once the Treasury is gone, it stands to reason that the Federal Reserve or the government, the Treasury, is going to issue Treasuries, right? And hopefully it's 10-year Treasuries. And what that will do in turn is increase the 10-year interest rates. Now, when you increase the 10-year interest rate or the longer end of those yields, it's going to impact mortgage rates. Okay, so understand, man, there's still a lot of money in the system right now, even though it's being drained at like light speed. Let me show you guys now the Treasury general account. So again, first is reverse repo market being drained. Then we want to look at the Treasury general account. Then we'll look at MBS, but let's look at the Treasury general. All right, so here's the Treasuries. Let's just say their spending account. Okay, so this is how they spend money. Now, we recently peaked in October 25th of this year. We peaked at $834 billion in the Treasury's general account. So what I want to point out is from October 25th to right now, so a little less than 2 months, they've spent $102 billion. And I could tell you guys, again, once the reverse repo market is drained, you're probably going to see the liquidity being drained rapidly out of the general account. And honestly, that's probably why the Federal Reserve is starting to pivot, because they are starting to realize once you take the money out of the system like that, things will come crashing down. And I'm going to go over what I believe, and I'm kind of certain of this, what the black swan is. Okay, so like, why did the Federal Reserve pivot? I think I have that answer, but before I get there, let's now look at the mortgage-backed securities held by the government. Now, understand a mortgage-backed security is basically a loan that they purchase, okay? And part of the reason we were able to get such low interest rates through COVID and lockdowns like 2 and 3% was because the Federal Reserve or the government purchased mortgages from the lenders that were lending at like 2 and 3%. Because what we know now is the lenders don't really make a lot of money offering loans at 2 and 3%. So in order for it to stay profitable for them, they had to sell those loans to government, in other words. Now, quantitative tightening is the government not purchasing assets, but rather selling assets. And remember, Jerome Powell was specific to us, and he said they're going to roll off the MBS or mortgage-backed securities from their balance sheet. However, when we look at what's going on, it's not happening very quickly. But before I bring up the mortgage-backed security chart, understand that the Federal Reserve has an ability to manipulate the mortgage and real estate market, even if it's not through the federal funds rate or their interest rate cuts and increases. They can still manipulate the market with 10-year treasuries or the longer end yield treasuries, and by continuing quantitative tightening, or rather not purchasing mortgage-backed securities. It's really important that y'all understand, as long as they continue to do the quantitative tightening in the form of MBS, we should be fine. Obviously, there's still some people that are flooding back into the housing market and the stock market and just spending like crazy, and that's a really bad thing. But regardless, let me show you MBS. Okay, so here's our MBS securities held, okay? And obviously, you guys can really see, okay, so this gray line, or where my arrow is at to the left of me right here, is when the lockdowns happen. So you can already see they were doing quantitative tightening. You see that before the lockdowns. You can see they were selling mortgage-backed securities because the real estate market right before lockdowns was not healthy. I remember that so well in 2019 because I had like an emergency meeting with my wife and we rebudgeted. So we went into all of this stimulus on a budget. So we actually did pretty well there. But you guys can see the surge of quantitative easing. So this is when they started purchasing all these loans. And what this did is it dropped mortgage rates even further than they were already. But unfortunately, you guys, they have been extremely, extremely slow at unwinding that damage. And really, we haven't had significant decreases until about August of 2022. And remember, they started in March of 2022. Even though they started quantitative tightening in March, right here, they really didn't sell many. They purchased a little bit, but they really didn't sell much mortgage-backed securities. So it wasn't until about August. You guys can see that they have been offloading that, or rather, they let it mature. And what I mean by mature is either someone pays their loan or refinances their loan, and then they don't have it on their balance sheet anymore. But you guys, they've only knocked out $297 billion in MBS in about 1 year and 8 months. And that, my friends, is not a very good thing. If they would continue to unload those mortgage-backed securities, by the way, no one wants to buy them, interest rates would stay elevated a little bit better, but that's not happening right now. And so the market continues to stay propped up. Now, one other form of liquidity I want to show you guys is the M2 money supply. For the first time since the 1929, so from the first time since the Great Depression, the M2 money supply, again, for the first time since the Great Depression, the M2 money supply, or the whole country's money supply, has been going down. It hasn't been until recently that we've seen it grow once again. Let me show you guys the M2 money supply. I'm only showing you guys the 1 year outlook, okay? It's a lot easier to see this now. M2 has been going down since about January of 2023. And again, that is a huge, huge deal, you guys. So we peaked around January 9th, and now the M2 has been going down. Again, the first time since the 1990s. Since the 1920s and 1930s, this has been going down. Now, I do want to point out that we did bottom out for M2. So we hit a bottom in M2 on October 30th of this year. It's actually right here. So that's when we hit the bottom. And that's actually pretty astounding to me. So since then, in the month of December, for the first time since January, M2 has actually gone up. Do y'all see that right there? So, you know, that's probably a little concerning as well for the Federal Reserve, because it can lead to inflation or runaway inflation, which we already have in shelter. We already have that in the housing market. It's starting to change with auto, though. But regardless, we really need something to happen in the housing market, right? Shelter, which is really important to so many of us. But it hasn't been until recently that the M2 money supply has actually been going up. So we'll keep our eye on that as well. Now, real quick, let me show you guys what the injection of liquidity really did when it comes to the housing market. Now, this graph is the Case-Shiller Home Price Index, which, by the way, is greatly lagged. So I know we hit, oh my gosh, all-time records. But you guys, it's almost January and they're talking about October. But when we lay Case-Shiller over CPI, you can really see that liquidity injection, look at how much bigger it got the bubble. I mean, the bubble was big already. You can see the divergence right here. This is the great financial crisis right here. You can see that the bubble popped and then it got bigger. They started doing quantitative tightening around here. But instead of a correction or a rebalancing the housing market, things just got worse instead. Okay, that's what I'm trying to explain to everyone. It got worse when we needed it to get better. And you saw that right here when home prices went down and then they rebounded. I mean, that is a heck of a rebound this year. But regardless, you guys, what I'm trying to explain to everyone is there's an overwhelming amount of pressure specifically on homes. They are trying so hard to keep the values of homes there. It's so ridiculous, which means when they start going down, home values on a nationwide average, and they stay down and they don't rebound like they did this year, it is going to be devastating to the markets, you guys. Absolutely devastating, because there's so much that's leaning on the values of houses staying propped up. Now, the question is being that we have so much like liquidity, what is going to be the black swan that basically causes everything to fall apart? Now, I'm going to tell you guys right now that I'm pretty certain that I know what that is. And when we look back at what happened this year in 2023, it makes a lot more sense. And that is, you guys, commercial real estate. I'm going to tell you guys right now, in my opinion, that's what has Jerome Powell so freaked out right now. And it makes sense. Commercial real estate is going through a hell of a lot of turbulence. And when we look back on the fact that we lost three or four banks this year just because of the change of interest rates, that's it. Not even defaults, okay? And consumer defaults is what really puts lenders out of business. When consumers stop paying their debt, things break and fall apart. Now, the most recent bank failure of Citizens Bank was a result of defaults with truck loans. So if truck loans can take out a bank, imagine what commercial real estate defaults will really do. And you guys, I'm telling you right now, the people behind the scenes, they see it happening right now. It's just the thing is most of society doesn't care. And I find that very, very disappointing. But let me bring up a couple headlines right now about the commercial real estate meltdown. Again, you guys, just a couple headlines here. Interest-only loans helped commercial property boom. Now they're coming due. Landlords face a $1.5 trillion bill for commercial mortgages over the next 3 years. And that's right, you guys, it's going to get worse from here on out. It's going to get get the worst in 2025. And that's probably what I believe is when we're going to see the highest unemployment, or rather the possibility of unhinged unemployment. I think it gets worse in 2025 as a result of commercial real estate. Now, this chart right here is telling us the share of commercial mortgage-backed security loans that are interest only by year of issuance. So they're not even paying down their principal. The loan is just staying the same. You can see that it's surged, y'all. In 2020, 2021, and in 2022, that means essentially they're not paying down their loans. Their loans are staying the same. This is very, very dangerous. A couple quotes here. What we're seeing is the unfortunate collision of the most rapid increase in interest rates in a one-year period and the realities of how people work. Now, managing director at data company CoStar's risk analytics team estimates that as much as 83% of outstanding office loans won't be able to refinance if interest rates stay at the same or current level. So again, you guys, this is what has Jerome Powell so freaked out right now. It's falling apart, and it's probably going to hit blindside America. Shockingly. This is an interesting chart right here. This is commercial mortgage maturities by lender types. And you all see that basically in 2023, how much is due, 2024, 2025, 2026, 2027. Now, this is a little bit different. This is obviously a combination of things: banks, commercial mortgage-backed securities, life insurance, just certain things. Now, across all lender types, 2.28 trillion loans will come due through 2027. All right. So again, we have a massive liquidity crisis right now, and that crisis started by liquidity injections in the market. Very interesting to think about how we got in this situation. And again, you guys, that money is being drained out of the economy at record speeds. I believe the black swan is commercial real estate. I think that's why the Federal Reserve is pivoting. Too bad we can't trust them and get transparency for them. Would you agree with that? And again, guys, do me a favor, comment below. Let me know what your thoughts are on this video. Let me know your thoughts on the liquidity situation, and let me know your thoughts on commercial real estate and whether or not you believe that's the next black swan. Now, other than that, I hope you guys got some overwhelming value, insights, and perspective. And if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.